Welcome to the Debit This, Credit That podcast with Wheeler Accountants, located in San Jose, California. In this podcast, we discuss how to solve accounting challenges in both your personal life and your business. We take an energetic, tech-savvy approach to solving accounting challenges that steal your focus and your time. Now, on to the show with your tech-savvy accounting experts, Matt Wheeler and Michael Bryant.
Welcome to episode 31 of the Debit This, Credit That podcast by Wheeler Accountants with your hosts Matt Wheeler and Michael Bryant. Michael can't make our recording session today, so yours truly, Mr. Wheeler, will be doing the podcast today. We're going to do a Q&A podcast, some of our common listener and client questions, tax-related. Before I get into that, I did want to do a quick plug for the Damn Cancer Foundation again. I've mentioned it a few times. The Damn Cancer Foundation is a 501c3 charitable organization, and our mission is to provide financial assistance to young adults diagnosed with cancer and to also fund innovative cancer treatments and research. My buddy David Pumadden was diagnosed in cancer at the age of 25, straight out of school, and just when he started working, he didn't have any financial savings to really help fund, not necessarily the actual cost of treatment, but all the other costs associated with going through treatment when you can't work. The reality is you get a little bit of money from like Social Security, disability, and some of that stuff, but it's not enough to cover rent, utilities, travel to and from treatments, lodging if you need to stay near the hospital for treatments, but you're not necessarily an inpatient. So our foundation covers that gap. We bridge that gap between what insurance covers and what you need to pay for otherwise. We've raised about $1.2 million to date since 2008. We provided financial grants we're coming up on 400 financial grants we've given to people. Approximately $600,000 we've given away. We've also funded $150,000 towards cancer treatment research at USC. They're doing a really cool clinical trial there and some targeted non-invasive research against osteosarcoma, which is the cancer Pooh had. So just wanted to mention it again. Please support the foundation any way you can. You can make tax-deductible donations on our website. That's www.dam-cancer.org. You can also follow the foundation on social media. We're on Twitter, we're on Instagram, we're on Facebook. @DamnCancer is the Twitter handle, and @Dam_Cancer is the Instagram handle, I believe. So please support the podcast. Make a little note you're a listener if you do make a donation, and appreciate everything that you could do for us. All right, so today we'll get into a little bit of Q&A, like I said, from our listeners and our clients here at the firm. Got several questions to go over, some interesting ones today. First, I'm going to go ahead and start with one from one of our clients. And here we go. Hey, Wheeler, I'm going back to work for a year for an Estonian firm. I have a question about how I deal with my compensation from a tax perspective. As the first U.S. employee, in quotes, this is new territory for the company. Unlike my previous company, the firm does not have a U.S. business entity, and therefore I will be paid directly from the Estonian entity, although I will be remaining living and working from San Francisco with occasional European business travel. Even though I've committed to a year as a self-employed contractor, the position will be categorized by the Estonian entity as a permanent position. How do I deal with the Estonian/U.S. taxes on this income? I assume I'm not double taxed. And then he also had a question about whether or not he needs to establish an independent self-employed tax ID number, or whether he can use his own Social Security number. So it's a good question. There's several things going on here. The easy first question to answer is you don't need to get a separate tax ID number for yourself when you're going to be a self-employed consultant. You can use your personal Social Security number, although clients and people will often get a tax ID number, and I do recommend they do that. Having the tax ID number can be a little bit of privacy for you. You don't have to pass out your social to everyone. You can obtain a tax ID number online at the irs.gov website very easily. You just go and you apply online for the EIN. It takes a few minutes. You can do it for banking purposes. You can just say you started a new business. You want to make sure you answer the question no, that you're going to have employees if you're not. Otherwise, the IRS is going to be expecting to receive some payroll tax returns for you on a quarterly basis, and you don't want to have to get into that whole thing if you're not going to do payroll. But you can get an EIN if you want to, but you don't need to. The other part of the question was about just generally how the taxation is going to work. This client in particular is going to be working for a foreign company based in a foreign country, but they'll be doing the work here in the United States. So as far as the foreign part's concerned, you usually look to the tax treaty between the U.S. and the foreign country. What you don't want to do is you don't need to worry about paying the foreign tax typically if the treaty says you're doing all the work here in the U.S. So the treaty will specify which country has the right to tax you. If you're working out of the U.S., then typically you're taxed in the U.S. If you're working in the foreign country, typically you're taxed by the foreign country. If you're taxed by the foreign country, then you will pay foreign income tax to that country. The U.S. will still tax you on your worldwide income, but you receive a tax credit for the taxes you've paid to the foreign country to mitigate the impact of double taxation. This is how most of the standard income tax treaties work. In this case, this client will be working in the U.S., so the U.S. will be the country that's allowed to tax the compensation income. Thresholds on this particular treaty with Estonia about how much time they spend in Estonia before they're subject to Estonian tax, or vice versa in the U.S. if they're an Estonian citizen. We don't advise on the Estonian tax implications. It's not something that we do. So what we do is just typically handle the U.S. side of the tax thing. But since the client will be working here out of the U.S., just paying U.S. tax, don't need to worry about the Estonian side. If they do end up traveling quite a bit to Estonia, we want to look into the Estonian situation. Probably recommend they hire some sort of tax firm on the Estonian side to help out with that, and then we would use that to calculate the tax credit they pay here in the U.S. on the foreign taxes. So fun stuff there, but bottom line, it's not much different than being a self-employed contractor as you would be in the United States. Pretty straightforward. Next question. Hey, Wheeler Accountants, I have a potential situation I want to run by you. I have a property for sale in Novato. Unfortunately, I'm not getting the response I expected from a sale price perspective, and I may consider holding it for a year and selling it then. In the interim, I would just rent it out. Couple questions. I have around $200,000 invested in renovation expenses and another $45,000 to $50,000 in closing costs, staging, holding costs, etc. Will we be able to capture those as expenses when we rent out the property? Yes or no? Question 2. I need to pull out equity to pay back investors, around $150,000. How do you think I can best structure that from a tax perspective? And the third question is, when I rent it now, I will have negative cash flow. Will we be able to capture this on our taxes next year? So 3 really good questions here from this client. Number 1, for the renovation expenses and the closing costs and everything else, we can capture those when we're not the property, but those are all going to be capitalized into the cost of the property. The $45,000 to $50,000 in closing costs and everything, that is definitely capitalized as part of the acquisition price of the property. We would typically allocate a portion of those costs towards the building and then a portion of those costs towards the land. That distinction is important because land is not depreciable in a rental activity, so we cannot write off the cost of the land over a period of time. It's just a permanent cost item that will then recoup in a future sale where it will reduce our gain, basically. Any of the closing costs allocated to the building side, will be able to depreciate over a number of years. The class life on a residential piece of rental real estate is 27 and a half years, so we'll be able to recover the costs associated with the building portion over 27 and a half years. So we do want to allocate between the two, the building and the land. The actual percentage used for each allocation, there's no black or white method. Most clients will not go out and get like some sort of appraisal to allocate between building and land. So what we'll typically do is just pick a rough estimate as a percentage. Typical percentages can be 70% building, 30% land, or 75-25 or 80-20. If it's like a condo or something with not a lot of land and mostly building, we'll go higher on the building part. Usually a 70-30 or 75-25 is common for like a single family residence. However, if it is in a really high cost area or you just bought dirt to begin with, it's pretty easy to allocate that part to the land because we know how much you paid for the land. So you just need to look at it. The land values are going up. You're seeing there was a house in San Jose that made like headlines because it was basically a shack for sale for like $1 million, and it's just people are buying it for the dirt and they're going to tear down the shack, right? So in those situations, it's pretty clear a lot of value is associated with the land and not so much with the building, but usually we'll do a 70-30, 75-25. The 200 renovation expenses is important. You have to capitalize that as part of the cost of the building. You can go ahead and, in some cases, you can get a cost segregation study done. That's when you hire a specialized accounting/engineering firm. They're kind of like a combination, and they'll come in and they will identify components of that $200,000 that apply to assets that have a class life under the 27 and a half years. So some components may have like a 5 or 7 year life, and those are depreciable over a shorter period of time and eligible for accelerated depreciation, whereas the building is not. Basically, it allows us to do faster write-off over time. But if you go through all the invoices on the $200,000, we can identify which ones are 5 or 7 year assets, which ones are 15-year land improvements like fencing and that sort of thing. And then we can depreciate those things a little faster than 27 and a half years. So you can recover your cost a little sooner. Anything else, though, it's going to be part of the structural building, basically, or some of those things. That'll be 27 and a half year property recovered over that period of time. Also, there is one other thing that came into play several years ago when the IRS finalized the tangible property regulations, and that's called a partial disposition election. This is also a very big write-off as well in the right circumstances. If you buy a piece of property and then let's say you gut the kitchen and the bathroom and totally redo them and you incur the $200,000 for the kitchen and the bathroom, the IRS will allow us to carve out a portion of the purchase price of the property that's allocable to the kitchen and the bathroom, and then we can turn around and immediately write that off because you've essentially disposed of that portion of the building because you've gutted it and redone it. So you will be able to get a write-off for roughly the full $200,000 of replacement cost based on that's how much of the building you took out to gut and replace. Then you will add in the $200,000 of new renovation expense as a capital expense or capital improvement, which you will then depreciate. Some of it may be the 5 and 7 year property we just talked about over an accelerated portion of time. So you can get quite a bit of write-off in year one with big, reno jobs that you do on a new property. So you want to have good books and records as far as how you're allocating costs from the contractor or from the subcontractors you're using on the various improvements you're doing, because we can write off some of those things quite a bit faster than we would be able to otherwise. So pay attention to those costs, keep good records. If you want to run those by us at the firm, you can, and we can help you differentiate the different types, but that's a way to get a lot of write-off up front. Second question he had was about pulling out equity to pay back investors, and that's could be a tricky one. You can't really pull out equity out of a property you haven't sold yet. My advice here in this case was perhaps he could do a cash out refinance on the property after a period of time, whatever the lender allows. That's the most tax efficient way, I think, to pull the money out of the property, because there's not going to be any tax consequence to cashing out from a refinance because you're on the hook for the loan later. So you're basically deferring the tax consequence on that cash coming out until you sell the property in the future. Once it's sold, you're going to take the proceeds from the sale. You're going to pay down the loan at that point in time, but you're going to have gain on the full amount of the sale of the property. So you've essentially got the money early, but not paid tax on it till later when you sold the property. So a cash out refinance can be a good way to pay off the investors. Otherwise, if you're going to have to hold, then they can wait, and maybe they share in a portion of the rental proceeds or whatnot, depending on how you structured your deal, so that they're going to share in some of that income as well in the meantime. His last question was about renting it out. He's going to have negative cash flow, and can he capture that on the taxes next year? We need to remember that cash flow is not necessarily always the same as the tax loss. There's a couple things that are going to be different there. Number one, the principal you're paying down on the loan on the property, if there's a loan, that's not going to be a write-off, but it is going to be a cash flow negative expense. So your income's going to be a little higher for the amount of principal you're paying down because you're not getting a write-off for the principal. On the flip side, the depreciation we just talked about in the first question, all that's going to be a tax write-off, but it's not going to be a cash expense. So you're going to have these offsetting things. Typically, if you have negative cash flow, you're most likely looking at negative taxable income on the property. And if you have a negative taxable income property that's a rental, it's going to fall under the passive loss rules, the passive activity loss rules for tax purposes. That simply means that if we have a net passive loss on a single activity, we can use that passive loss to offset passive income from other sources, other rental properties, other passive business interests that have flow through pass-through income, but we cannot use that passive loss against compensation income, wage or service income, intangible income or investment income like interest, dividends, capital gains. So if you do have a net loss and you don't have any other passive income to offset it against, it's going to accumulate and carry forward as a passive activity loss. Each property that generates a passive loss will be tracked in its own bucket, and then we'll track those buckets of losses moving forward in the future. And you can dump out the bucket and take those losses in the year you either sell the property in a fully taxable transaction, or if you have other properties or other passive interests in the future that generate income, you can then use those accumulated passive losses in that bucket to soak up some of the passive income from the other activities in those future years. So you don't lose it permanently. just timing difference. You're carrying this loss forward and they can use it in the future once you have some passive income that you can offset it against. Next question was from a client. Hey, Wheeler, quick question. How much of my mother's care fees and rent are deductible under the new tax rules? I have a letter from her doctor that has a diagnosis of dementia. She's going through about $10,000 a month. The facility is certified for memory care. I'm hoping they would be considered health care given the amount of care she requires. I am revamping and augmenting her trust to help generate more income before we find her without any funds. I'm asking the questions first under the boundaries before I find us in an unwelcome taxable situation. First of all, thank you for reaching out with a tax question ahead of time. So it's always good when clients ask, and we welcome questions like this. We don't want you to make decisions just based on what you read on the internet or talking to friends. Consult with a tax professional like ourselves. The answer to this client is that typically the entire amount is a deductible expense. There are a certain set of rules that we need to be concerned with to determine how much of like an assisted living facility's expenses can be deductible as medical costs. There's a daily living test and there's a cognitive impairment test. I'm not going to get into all the details right now. They can get a little intricate, but basically if the taxpayer requires assistance with 2 or more activities of daily living, then we can start allocating a portion of the care towards medical costs. Or if they have like significant cognitive impairment as like diagnosed from a physician, then they may be able to do it too. So a lot of times the facility will give you a letter or some sort of memorandum that estimates the portion of their expenses that are allocated towards medical care. But when the person is needing full-time, round-the-clock care and can't really do much on their own, typically a large portion, if not all of the expense is going to be deductible. It's always best to check with the facility and ask them if they have a memo or letter. They should be preparing this pretty much on an annual basis for their patients or clients or whatever you would call them. So you check with them, but a large portion of it can be deductible. And this is a tax strategy item that we will discuss with clients who have aging parents, is that if you have these large medical expenses, in this case, $10,000 a month is not an insignificant amount of expense. It's a $120,000 medical expense every year, perhaps on top of other costs as well, but probably that's the majority of it. You would count insurance and everything in there as well you could deduct. That's the big write-off we have every year. If that taxpayer had income from other sources, we could try to accelerate income into those tax years that we have the big expenses in order to subject that income to tax, but then not have any tax actually owed. The biggest example we usually use is pulling money out of an IRA or a 401k or something. That money is sitting in there in a tax-deferred or pre-tax retirement account. So whoever pulls the money out of that account now or in the future is going to pay income tax on that money that comes out. If you inherit one of those accounts from a relative, from a parent, then you're the beneficiary. You're going to have to start pulling money out according to the minimum distribution rule, and you're going to pay income tax on the income you receive. If your parent withdraws a bunch of that money and converts it into just cash in a regular bank account, they're going to recognize income on the entire amount of the withdrawal. Let's say we took out $100,000 out of the IRA. We have $100,000 of income. We have $120,000 of medical expense also. It's going to wipe away all the income. So now we got $100,000 out. We put it into cash. And now if the aging parent passes away and you inherit cash, there's no income tax consequence of the beneficiaries there. So that's a planning tool we can use to mitigate the overall income tax hit to the family by taking advantage of these large expenses that taxpayers tend to have later in life for the full-time care and really have a lot of tax savings. So that's one thing we do go through when the situation pops up, and one thing we talked about with the client. Sometimes they don't have the retirement accounts anymore. They've already been drained. That definitely happens. But if they do, and they also have other assets they're using to pay for the medical care, we may want to accelerate some of that pre-tax money, like the IRA money, into the current tax year to take advantage of the write-offs. Next question. Wheeler Accountants. When I joined my company, I was granted a stock option, type of which is shown as follows in the documentation. Section 1, kind of option. This option is intended to be either an incentive stock option intended to meet the requirements of Section 422 of the Code, an ISO in quotes, or a non-statutory option, an NSO in quotes, which is not intended to meet the requirements of an ISO, as indicated in the Notice of Stock Option Grant. Even if this option is designated as an ISO, shall be deemed to be an NSO to the extent required by the $100,000 annual limitation under Section 422D of the Code. I wish to exercise, but will not be selling. My hope is that when I finally sell via company buyout or IPO or question mark, the stock will be worth more and I will declare a capital gain, on which I will pay no tax due to capital losses, which I have unfortunately piled up. Do I have to do anything exercising to have this become an ISO or a non-ISO? I think I want ISO, right? So besides the legalese of having to read the option language, this is a pretty good question here. The client is asking whether they should exercise now or not, and also what type of option they want here. And typically you don't have a choice in what type of option. You're granted what the option is going to be. Usually the better one to have is going to be an incentive stock option, an ISO. That's called a statutory stock option. And it will typically be ISOs, but they have that $100,000 limitation in there. That's something that applies where if you're granted more than $100,000 worth of the option, like in a single year, part of it becomes converted to a non-qual option or a non-qualified stock option, an NSO. You don't have much choice there. It happens when it happens, and you can't do anything about it. If you get a lot of options at a company, you may find yourself in the situation where some are ISO, some are NSO. But typically, we want all ISO as much as possible as ISO. They have different tax treatments on these types of options. For the NSO, for the non-qualified stock option, once you purchase it, you're triggering a taxable event at that time for regular tax and for alternative minimum tax or AMT. You're going to recognize income on the spread or the difference between the fair market value of the option and the strike price. So you're going to have an income tax consequence immediately upon purchasing. Even if you hold on to it, you're going to owe tax on that spread or that difference. So if the spread is big, you're going to have to either come up with cash out of pocket to pay the taxes, or typically what's going to happen is you're just going to sell the shares immediately and do a same-day sale or cashless exercise of the two of the terms we often hear to help pay for the taxes, and you'll just get to keep the net cash amount on the NSO. So NSOs we typically do not exercise right away. We hang on to those, and then we just cash those out when we want to liquidate them and we think the stock price is good and get some money. But you're going to pay a pretty steep tax hit. It's going to be all ordinary income on the entire spread. So you're going to be prepared just to pay a lot of tax when you do have a exercise of an NSO. Now, an ISO is a little different. An ISO, when you purchase it, when you exercise it, there's no regular tax consequence to that one. So if you buy it and you hold it, you don't owe any regular income tax. Now, for AMT, there is going to be a tax consequence. That same spread, that difference between the fair market value and the strike price, that's going to be AMT income for you. So you want to be careful about buying the ISOs and holding, because you may trigger some AMT tax that you're going to owe. Now, under the new law that just passed at the end of last year, Tax Cuts and Jobs Act, the threshold at which the AMT exemption phases out has been raised substantially. So we're finding a lot of people are now not in AMT. Additionally, some of the expenses that typically would have driven us into AMT in the past, like high state income taxes and high property taxes, those are now capped at $10,000 under the new tax law every year, how much you can deduct. So a lot less people are now in AMT than they were in the past. But I think there's opportunity here for a lot of taxpayers to purchase some ISOs and hold them and to trigger some AMT income, yet not pay any AMT tax out of pocket because they're not in AMT because of the new tax law changes. That's what this client may want to consider here, is seeing how much you can exercise, where that break-even point is between AMT and regular tax, and trying to buy that many shares. And that's an analysis we'll typically run for those clients. I'd probably say wait till the end of the year to do this. That way we know we have a good idea what the year's tax liability is looking like and all the income and expense items for the year. Then we can figure out what that break-even point is and have you purchase that many shares so that you're covered, or you're not paying too much AMT, you're just paying regular tax. Well, I guess you're not paying either. You're exercising and buying them without paying any tax out of pocket. You got a free AMT basis adjustment because you bought them, so you have AMT income, but you didn't pay any AMT tax. I'm sure I confused you on that one. The bottom line is that you want to wait till the end of the year, see how much you can buy without triggering a tax event. And ISOs are the way to do that, whereas NSOs, you don't have that kind of flexibility. Another thing this client should think about is when you buy the shares, the overall size of the company involved, because there's a special tax rule called qualified small business stock that a lot of our clients here in Silicon Valley get to take advantage of, where if you invest or acquire stock in a qualified small business, then you can eventually, after 5 years of holding that stock, when you sell, exclude 100% of the gain from tax, up to $10 million of gain. This is a really big tax benefit that people can get on the federal side. But there's requirements about the company and the shares when you get them to qualify. One of them is that the company has $50 million or less in gross assets. So typically the earlier you buy these ISOs, you may be able to buy during a QSBS period where the company qualifies as qualified small business stock. You still got to hold the shares for 5 years before you can actually take advantage of the exclusion. But typically the sooner you buy, the better. Also, if it's a company that's going somewhere, like a tech company, and they're raising a bunch of money, like successive rounds of financing, the valuation should be creeping up. The sooner you buy, the lower that spread is between the market value and the strike price on your options. So the sooner you buy, the less AMT income you have on the ISOs, and the more you can acquire without paying a tax hit. If you wait too long, it can become prohibitively expensive to buy the shares, and now you're kind of stuck waiting until a liquidity event, and then you can just buy them and sell them all at once in the same day. Now you're not going to get that long-term capital gain treatment of having held the shares for at least a year or 5 years, the tax-free treatment. You're going to get ordinary income treatment on that. That can be a big tax hit. This is a really good situation where you want to be talking to us early on as soon as the grant happens so we can help decide and map out what's the best strategy to go about here in acquiring shares in the company. Typically earlier is better. So call us. We can see what your break-even point is, how many shares you can acquire without a tax hit. Maybe there's a small tax hit, but it's not too bad. We can also see if it qualifies for QSBS, so you're aware of that 5-year holding period requirement, and you start working towards that. A lot of things to be thinking about here. And great, this client reached out to ask for advice because it's something we can definitely help with. Next question. Hey, Wheeler Accountants. I'm in the process of selling a couple hundred acres of land in West Virginia. I'll need to sort out how to do the 2018 estimated taxes as well as several other things. I will also have to file West Virginia state income tax next year, and the West Virginia lawyer is already in the process of withholding funds for West Virginia state taxes. My father originally owned different parcels of land, and I acquired various parts decades ago. There's several different ways. All of this land is now being sold as a single one-sale unit. However, sorting out my cost basis is somewhat complex and complicated. Before we meet, if you could answer one question for me, you could help me sort out and define my cost basis in preparation for our meeting. My question is, if parents give the land to their son and his wife, the parents bought the land for $20,000, parents' cost basis equals $20,000. When the parents give land to son, the value of the land is $150,000. When the land is given, the gift tax exclusion is $10,000. Therefore, parents can gift to son and his wife 4 times $10,000 equals $40,000. Is the son's cost basis $40,000 or $20,000? Whew, a lot of numbers there. Okay, a few issues here from a tax perspective. On the West Virginia thing, different sources of income have different ways they're taxed for state tax purposes. Real property is typically taxed to the state where the real property is located. So if there's income either from rental or from a sale, a gain of real property in a certain state, you're going to pay income tax to that state. In this case, they're selling land in West Virginia, and so if there's a gain on the land, they're going to owe West Virginia income tax. Here they mentioned the lawyer is going to be preparing paperwork to withhold funds and pay it to West Virginia for the taxpayer. That's how it happens a lot of times in different states. California has mandatory withholding on sales unless you fill out like some exemption worksheets. That's a way for the state to make sure they get paid their share of the gain, the tax on the gain. If you don't have the withholding done, you still owe the tax to that state. And if you don't pay it timely, you may be subject to some penalties or some interest basically for paying it a little bit later. So you really want to be on top of when you have a sale or something like that, or you're starting to operate a rental property in a new state outside of your home state, that you're aware of your tax obligations to that new state right away from the get-go. And you start reporting and paying in that state, even before you've ever filed a return in that state. So the state tax consequences are going to be that you're going to start paying tax to the state where the property is located. A lot of states like California, you're also going to recognize all the income here, but you're going to get a credit for the tax you paid to the other state. So you're going to end up not getting double taxed. But you will effectively pay the higher of the two rates if you're a California resident. So you're not getting out of California tax by having a rental in West Virginia or a gain in West Virginia. You're just going to pay West Virginia tax on the entire gain amount, and then you're going to pay California tax on the remainder up to the California gain amount. So that's about the whole state sourcing and where you're paying tax to situation. The second question this client had was about the cost basis in the land and how that works. This is one of those situations where they've acquired lots of pieces of land over various periods of time, so it is a little bit messy, but it's not going to be super complicated. It really boils down to just finding out for each like parcel or transaction that occurred, how was the property acquired, then we can determine what the cost basis is. In a gift transaction, the cost basis is going to be a carryover basis. So it's going to be whatever the basis was in the hands of the parents, that's what it'll be in the hands of the kids. client in this situation started to overly complicate things by bringing in the gift tax exclusion and that sort of thing, that doesn't come into play on the income tax part. So the answer to the client's question was when the cost the parents bought the land for was $20,000, that's going to be the cost for the kid that inherited it, or not inherited it, was gifted it, $20,000. Even though the value is $150,000, they're going to take over the $20,000 gift amount. So before you do gifting, you need to really be talking to us because there's trade-offs that you make. And one of the trade-offs is you make an income tax trade-off. So if you gift property, your donee is going to receive your donor's basis in the property. And if that's really low, you're transferring a built-in gain to your child or whoever the donee is. And they're going to pay income tax eventually on that. As compared with inheriting property, where if you hang on to it and then you pass away, the property is going to receive a step up or step down in basis to the current fair value of the property on your passing. So the property is worth $150,000 when the parent died, and then the child inherited the property. Now their tax basis is $150,000. It's not $20,000. So you wiped away $130,000 of unrealized taxable gain by inheriting it versus gifting it. The reason you get to do that is because the value of the land is subject to estate tax in the parent's death. But if they're not a taxable estate, there's no estate tax owed. So it's subject to estate tax, but they don't pay any estate tax. Now you inherit with a higher cost basis for income tax, so you get out of the income tax hit too. So a lot of times inheriting is better than gifting. We usually will start looking at gifting once we are thinking about doing more advanced estate planning strategies because we have a taxable estate and we're trying to get the appreciation out of our estate. Then we'll do gifting, because what a gift does at that time is fixes the value of the gift at that point in time. All the future appreciation is going to occur outside of your estate in the donee's estate because they own the property from that point forward. But at the point you do the gift, you have a taxable gift, and we have to report that gift on a gift tax return that gets added back into your estate when you die. You're just freezing the value at the time you make the gift in your estate and then getting all the future appreciation out of your estate. So that would have answered the client's question there. They probably would have had a lot more things going on. If they had acquired some parcels via purchase or some via inheritance, again, it's going to depend on each one. The inherited ones are going to have an income tax basis equal to the value at the time of inheritance. The gift ones are going to be a basis that's a carryover basis. The purchase is going to be a purchase. And then there may be some adjustments based on like rental activity over a period of time, if there was any of that, for depreciation taken and that sort of thing. So it can get complicated, but it just requires getting all the information, then we can go ahead and do all the work and figure out what the actual basis number is going to be. Hey, Wheeler Accountants. As you remember, in April, we bought a house in Aptos for $1.35 million to use this as a second home. If we sold our principal residence in San Jose, it may generate a large taxable gain. We potentially would like a smaller, less expensive home in San Jose, but it would pay a lot of taxes in trading down. An idea is to make the Aptos property our principal residence and rent the San Jose home for 2 years, thus converting it to an investment property, I believe. If we sold it after 2 years and did a 1031 exchange, how long would the new exchange property have to be rented, i.e. treated as an investment property, before we could convert it to a second home? The basis in our San Jose home was around $700,000. In today's market, we would probably net $2.2 million after sales costs. So that's $1.5 million of gain. With the one-time $500,000 exclusion, $1 million of taxable gain. I'm not sure how this all works, so I thought I'd inquire. Our goal is to have the house in Aptos. We will spend most of our time in a small house in San Jose. What would our potential tax hit be if we just sold the San Jose house and bought something smaller? Or any issues with the investment conversion scenario? Or do you have any other creative ideas? Let me know if I wasn't clear or omitted any details. It may be off base of my analysis. I value and appreciate your input. Thank you. All right. Good one. And yes, we do have creative ideas. So that's why I picked this question, because I think it's a really, really good one. And we encounter it quite a bit here in this area where we have highly appreciated home values and a completely insane real estate market. Number one option is we could just sell and pay the tax. So the client asked about that. You buy your house for $700,000. You could walk away with 2.2 net. Let's assume no mortgage. She didn't mention that, but I assume the net is 2.2 with no mortgage. That's a $1.5 million gain. Because they lived in the San Jose house for 2 years of the last 5, they can use the one-time $500,000 exclusion from gain on a sale of a primary residence. They'd have a $1 million taxable gain. $1 million taxable gain, we figure 23.8% is the federal long-term capital gain rate. 13.3% is the maximum California capital gain rate, or just income rate in general. So we're looking at 37.1%. $371,000 of tax owed on the $1 million taxable gain. So if you're looking at $371,000 on $2.2 million proceeds, that's not a terrible tax rate. We're looking at overall, what's that, like a little over 15% probably total. Not too bad. Maybe it's worth just taking the money, walking away. The advantage there is that now you can have full use of those proceeds any way you want, and you can do whatever you want with it. You've already paid the tax on it. And you did pay some tax, and $371,000 is not insignificant, but you can do whatever you want with the funds. The other option, which the client mentioned, is to do a 1031 exchange. 1031 tax-deferred exchange is when you exchange a real property used for trade or business or investment for another property of like kind, which is used for trade or business or investment. Typically, this is just for like a rental property for a rental property or that sort of thing. So if they move out of the San Jose house and rent it for a couple of years, then they can do a 1031 exchange. They can roll over or defer the gain into the new property. You want to have as much time as possible before you start the 1031 exchange as well as after. We typically recommend seasoning the property 2 years before the exchange and 2 years after before you do anything with it. That way you can accomplish the exchange and not have a problem with the IRS. If you do less time, it's still possible, but it doesn't look as good. If you're just doing it for tax avoidance and you want to move into the property or do something right afterwards, use it personally, that kind of thing, the IRS has some judicial doctrines they can use to kind of see through your plan there. They call it the step transaction doctrine, and they can basically say, your intent was really just to use this personally, so we're going to treat it as a taxable sale. So you want to be careful. You want to structure it properly. You want enough time before and after the sale to make it happen. Now, if you go that route and you start renting it now, you're waiting 2 years to sell. If the market's not as good, you're going to have an issue in 2 years where you're going to get less of a price. Maybe it's better to pay the tax and sell now. But all things being equal, wait 2 years, you sell, then you can sell, then you can roll into the new property, then you're free and clear, basically. A couple more things on the 1031 thing there. Number one, since they use the property as a principal residence, they can still exclude the $500,000 from the gain. So if they had that $1.5 million gain that they want to 1031 into a new property, normally in normal rental-to-rental 1031, you're going to defer the entire $1.5 million gain into the new property, and then if you sell that property in the future, you still have the $1.5 million gain you got to deal with. But in this case, they use the San Jose house as a primary residence. They can use that $500,000 of exclusion and bring it down to a $1 million gain. Now you're deferring a $1 million gain with the new property. So they were able to whittle it away. And if they do sell that property in the future property, then at least they're only paying tax on the $1 million, not the $1.5 million. But one of the things they said that caught my ear or eye is that they wanted to buy a smaller home in San Jose. They wanted to trade down. So a 1031 only works to defer the whole gain when you basically reinvest the entire proceeds into the new replacement property. If you're trading down and pulling any money out, or if you have a mortgage on the property you sold and you pay off the mortgage and don't have a mortgage on the new property, that's going to be considered what's called boot, which is taxable income to you. So you're going to have some tax consequence to trading down if you take any cash out of the deal or any debt reduction and you don't trade that into the new property. So you got to be careful about the trading down part. They may be okay with doing that. They may want to pull out a couple $100,000 here and just pay tax on a couple $100,000, say $300,000. So now we're looking like $100,000 of tax. It's not as bad as $1 million, but you are going to have some tax consequence. You can't just get money out and do a 1031 deferred exchange. It's a trade-off like a lot of things in tax. You can defer and not pay tax on the gain now, but you can't use the money. It's got to go on the new property. Or you can get the money now, but you're going to pay the tax. You're going to have a taxable gain. One or the other, not both. So those are the two basic things there I talk about with this client. This is a tough one. They're trading down. Depends what they want to buy. If they wanted to, they're going to buy down and they were going to still have like $600,000 they're going to get to take out. Like they're going to buy a $1.6 million house out of the 2.2. They're going to keep 600. They're almost paying tax on the full $1 million. You may just want to do the sale, not buy the 1031 exchange, and not do the whole rental and all that kind of stuff. Because then you're going to have to do the rental thing for 2 years before and after. You have rental headache of being a landlord, all that kind of stuff. Maybe you just want to sell and buy and pay the tax and be done with it. But if they're going to buy equal and not trade down like they're talking about, well, now maybe it's worth doing the 1031 exchange, doing the rental thing, because deferring tax on a couple $100,000 is, good amount of money. And if they hold it until one or both of them passes away, they may have that step up in basis we talked about earlier on the gifting inheriting thing and never pay income tax on the $1 million gain. So if you're real smart about it, you can keep rolling the property over and over and keep deferring the gain. And then when you pass away, never pay the tax. You don't have a taxable estate. Or if you do, you pay a little bit of estate tax, but no income tax. So a lot of things to think about. This is what we love about our job. It makes it interesting for us. Last question here. Wheeler Accountants. We're picking up a new condo in the city. A few questions. Should we create an LLC per property? We like the liability protection, but it could get expensive from an annual fee and filing perspective. What are your thoughts? This is just our second investment property. We're looking into our overall umbrella insurance to make sure we have enough coverage as well. Do we put this into the trust then? And the other question actually was a little more client specific, so we'll just stay with the first question for now. This one comes up a lot. Should I put my rental property into an LLC? And the way I look at it, and we're not attorneys here, this is a liability protection question, really. From an income tax standpoint, there's no difference between having an LLC or not having it in an LLC. When you own 100% of an LLC, it's a disregarded entity for federal tax purposes. That simply means that it doesn't even exist. Like it's not even there. You still file all the rental activity on a Schedule E on your 1040 on your personal return, so it looks the same as if you did not have it in an LLC. There's an extra California filing that we do, a 568 form for the LLC. It's a pretty simple form, but it is an extra form. There's also an $800 a year minimum tax to California you pay. So now you pay $800 a year to keep the LLC open for the privilege of doing business in our fine state. And there's also an LLC gross receipts fee, which would apply if the gross receipts on the property are over $250,000, $250,000, then you're going to pay a $900 fee. And it kind of bumps up from there as you reach additional gross receipts thresholds. Most single-family rentals aren't going to get $250 a year of rental income, so you're not going to have that gross receipts fee be an issue, but that's there also. So there's costs. There's cost to having an LLC, but there's no income tax benefit from having an LLC. Nothing's going to be suddenly deductible that wasn't deductible before or anything like that. So there's no income tax magic. But the reason the clients ask a lot of times is they're thinking about liability protection. They want to know how do they protect their other assets. And again, with the caveat that we're not attorneys, there is liability protection for having an LLC. It's a limited liability company. It's supposed to shield your other personal assets from liability in the event that you have a tax or a legal issue arise inside the LLC. The problem that I have that I advise clients on is that the LLC is not going to pay your legal bills to defend yourself in a lawsuit. The LLC is going to be like a final backstop to protect your remaining assets so that you are not getting hit with a huge liability on, some sort of legal action inside the LLC. So I look at it in terms of you have like 4 layers of protection. Number 1, you want to pick a good renter. If you pick a good renter that's stable, solid, and you're not going to be worrying about being sued by them because they're not looking for money or anything like that, then that's your first line of protection. Line of protection number 2, the rental insurance policy is going to cover you for any kind of like slip, fall, those types of issues that are going to arise with owning a rental property where someone could get injured or hurt on your property and they're going to go after you and sue you. That policy will help cover you there. It's also going to help pay some of your defense costs or, fight the claim. Number 3, a personal umbrella. The client asked about that one. I agree. A personal umbrella is a great way to add a little more liability protection. It's extremely inexpensive, relatively speaking. You can get $1 million of coverage on a personal umbrella for like a few $100s a year. You want to look at how much your total assets are worth and try and get umbrella coverage for most of that. It's going to be worth the money just to have that extra layer of protection. That's going to be number 3. And then number 4 is the LLC, where it's going to shield the liability inside the LLC. So you got good renter 1, regular insurance policy 2, umbrella 3, LLC 4. The client also asked about putting like each rental in a per property situation. You can do that. Again, you're going to have those fees, $800 a year, but you're going to silo your liability into each LLC, which is nice, especially if you have a lot of properties and you have a lot of assets that may be worth the $100 a year. It's more like $1,000 with all the little fees and stuff that add up, but around $1,000 a year to have each LLC have that extra 4th layer of protection. You could put all your rentals into one LLC. Some people do that, but now you're exposing all of the assets inside that single LLC to claims from any one of those assets. So if something happens on property A and property B is also in the LLC, if someone sues the LLC, they may be able to get access to the assets of property B as well as property A because they're all inside the same LLC. If they were in different LLCs, you have a little more protection there. I'll typically tell clients if it's going to be a single-family rental home, unless you have a lot of assets outside of the rental, probably not worth getting an LLC, but you can look into it if you just want to pay the $1,000 a year to have it. If you have like a multi-tenant building, apartment building, duplex, triplex, fourplex, something like that, or bigger where there's a lot of units, there's a little more liability with those typically. So maybe that's a good one to put inside the LLC because you have some protection. Also, like a commercial building, a lot of times it's a good idea. If you own like a shopping center or something, you're going to get someone tripping over the thing in the parking lot, they're going to sue the shopping center. They're going to sue you, whatever, all that kind of stuff. So you want to make sure you have that kind of thing in an LLC, have some liability protection. Again, for the final time, I'm not an attorney, but these are the things based on my experience that we've seen, things you should be looking into. Just recognize you're going to have a little bit of cost with having an LLC, and is that $1,000 a year really worth it? But from an income tax perspective, there's no change going on there. It's going to be the same stuff as before. So you're not going to see any income tax advantage to doing that. All right, well, that wraps up the podcast for the day. Hope it was a helpful Q&A session. That's all for today's episode of the Debit This, Credit That podcast. As always, if you have any questions, you can contact your Wheeler accountants preparer, or you can submit a question online at our website in the Ask Wheeler section at the bottom of the page. Please remember to follow us on social media for regular updates. Our Twitter handle is @WheelerCPAs, and we are also on LinkedIn and Facebook. Please follow and listen along, and thank you for listening as we help you solve for accounting.